Hello and welcome to the download. I'm your host, Dave Richardson, and it is the ever popular Tuesdays broadcast, which is now no longer on Tuesdays most weeks because of our horrible schedule, Stu. But so it's now Fridays or whatever we were calling it whenever we would occasionally end up on a Friday,
Yeah,
which seems to be more the regular. I mean, the good news is for anyone watching us, and we do have people that we report to. They know we're working on Friday.
that's right.
Friday before long weekends, Friday in the summer when the weather's beautiful. We're not slacking off at all here. We're working right into the weekend.
That's right. Well, it's a busy. There's lots going on. There's lots going on. We like to keep working.
And there is lots going on, which is a problem because we normally do. Stu and I are pretty we're pretty intuitive here. We've been doing this for a long time, and hopefully you've been subscribing for a long time. And if you haven't, follow us, subscribe and follow us so where you get your podcasts and subscribe on YouTube so you can see both of us, two of the prettier faces in Canadian financial services. I believe Stu was recently recognized for his physical appearance. But so if you want to watch on YouTube, but we always go through a little preamble, and again because we've been doing this so long, we want it to be sort of a natural conversation because that's I think what most people like when they're listening to a podcast is kind of like they're sitting in on a conversation that Stu and I might be having in the office, and we started to go on all the different topics that we could attack today, Stu. And it is like you say, there's a lot going on for a Friday in July.
Yeah. Well, there's macro stuff. There's individual company stuff. There's lots going on.
So Stu, we've been in and out of the war
Yep.
in different ways, and it's starting to feel like it's going to linger a little bit longer. Probably already has lingered a little bit longer than we would have hoped. In fact, I guess we would have hoped it would have never started at all. But the net result is we got oil back up well over $80. We've got yield, 10-year U.S. yield popped above 470 a little bit yesterday. So as you're looking across everything that this impacts, by the way, Gordie Howe Bridge open today, but tariffs back on the table.
Yeah.
So my little hockey stick making company that I had going with the maple trees in my backyard, that's got to be put on hold because we got tariffs back. So out of all of this, Stu, what are you thinking of in the most in terms of the portfolios you're managing?
Well, yeah. So, I think you always start with interest rates, because they're kind of the bedrock to about valuation. You kind of you name it, and interest rates have been range bound or maybe at the top end of the range, as you say, like 4.6, 4.7%. Uh, the real interest rate has improved quite a bit over the last couple of years. It's higher. It's within kind of a stone's throw of its longer term average. When you get higher interest or you get higher oil prices, there's always this kind of delicate balance between should the Federal Reserve or central banks respond to maybe some near-term inflation caused by energy prices with higher interest rates, or should they acknowledge that the higher oil prices themselves are a depressant to some degree on activity? So that's always a delicate one. It depends a little bit on the mandate of the central bank. Like the European central banks often, where it's a very much inflation focused mandate, they often respond more frequently than say a dual mandate where you're responsible for both inflation and unemployment. Um, there's no question when oil prices rise, it ends up being a suppressant to different activity. We do have the Federal Reserve coming up next week. There's about of a third of a chance priced in of a higher interest rate. Um, I think as I say, like you never know which way they'll err, but the combination of higher oil prices and slightly higher interest rates in and of themselves are a bit of a suppressant. I think when you look at so we're kind of, where we like interest rates, anyways, in our minds are kind of in a range, and you're
Yeah.
collecting coupon. The big difference in the total return performance of bonds versus say 2 or 3 years ago is that the coupon is higher.
Yeah.
So, when you think about a 10-year bond with a duration of, call it 7, the duration is a measure of how much would the price change for a 100 basis point move in interest rates. So if we went from 4.7 to 5.7, you might lose 7% on a 10-year bond. You'd have picked up 4.7 in coupon, so you're down 2.3. When you see these kind of plus or minus 20 basis point moves, you're not seeing the same type of significant changes in the underlying price of the bond that you would have when rates were down at 1 or 2%. The next thing that energy stocks have perked up a little bit, but they're not like racing out to new highs, and I think that's reflective of we've seen this tension before. When oil prices went up so high, energy stocks didn't totally follow along. When they kind of crumbled following the apparent reopening of the strait for a period of time, they also didn't fall to the same degree as well. So, I think what energy price or energy stock investors are sitting there saying, there's more tension in the oil market. That's going to lead to some additional cash flow. And that's why, on both sides, they've kind of, they've been reasonable performers. But I think if you say, well, like, let's should they be kind of rambunctiously higher? Well, the strait could reopen. And if it did reopen and oil prices tumbled, should they be significantly lower? Well, the chances of it opening, closing, remains. So the oil prices, the oil stocks are they're kind of fine. The one area in the market, we were going to talk about sectors that has been quite poor on a relative basis is consumer discretionary. And big weights in the consumer discretionary play our role, which is things like Tesla and what have you. But even when you look at the average consumer discretionary stock, it has not led the market. And while the economy is pretty good, like historically, you used to always sit there and say, well, the U.S. economy is 70% consumption, so the consumer leads. The U.S. consumer leads.
Yes.
And that has not been the case in the last 3 to 6 months. So that's a notable difference, and part of that is this tension around higher interest rates, higher energy prices impacting consumption, impacting housing. So there are some big parts of the U.S. economy that aren't firing quite the same way. And then where it is really firing is on the data center build out, and mate, that hasn't this week anyways. It's a lot of capital spending. So it's been good for the industrial sector. It's been good for pockets of technology, but it also comes with a big discussion point. And we can talk through that a little bit. But so just on the economy side, I think those are kind of the three things. Oh, and then of course the trade, more tariffs,
Yeah.
which again, versus the first go, like the market is taking this in stride a little bit more because they know that tariffs are likely to exist at some level. Part is negotiation, part will be an actual payment. But again, we've had some events this week where the market kind of can say like, well, I've seen this movie before. So the ones that cause the most uncertainty are where the first time viewing of the movie, right? So that's kind of where we're at on some of the top down stuff.
Yeah, I still cry every time I watch Big Fish. I don't know why that one gets to me so much. It's a Wonderful Life too.
Yeah.
But yeah, some of the other movies that make me cry, and I'm an easy. It's easy to jerk the tears out of me. Yeah, you're right. You have that lessening impact every time you watch the sad show. But the big thing and one of the things, and you mentioned it in relation to the data centers, but we could also say we were discussing the idea the Houthis, well, they're firing missiles now, and you had all this work to get around the Strait of Hormuz to find different ways of getting out. Well, now you're blocking off another one, and just all of the build out of just infrastructure in general
Yep.
right? You travel quite a bit. I travel all across Canada. I go into any city, and even smaller cities, and I've never seen so much construction, road work, buildings going, everything, and that's happening all around the world. And that's and then you layer on this the data centers. It's an enormous amount of capital spending.
Yeah, and that capital spending needs to come from somewhere. So, um, you've heard a lot of CEOs say, before COVID, the world was focused on efficiency. Now it's focused on resilience, right? Resilience is more capital intense. So, to your point around like, Saudi Arabia, like you used to send, the ships, around the tip and into the Suez Canal. If you're going to build a pipeline, that's kind of duplicating an asset you already had, right? It takes more capital. So that capital has to come from somewhere. The government has to borrow it. It has to divert it from another form of spending. All of that is capital expenditure. So that money has to come from somewhere. The data centers, a massive build out. Google this week increased their capex from, call it around 180 billion to 200 billion or something like this. $20 billion is from one company. That's a lot of money when you're talking about call it a $30 trillion U.S. economy, and you're going to spend an extra 20 billion, just one company alone. So I think that goes back to the interest rate comment. Like real rates are within the range of normal, but we had a long period of time when central banks were trying to get inflation up to 2%, and yields were quite low. Now we're probably in a period of time where the coupon of rates is more attractive. And the periods of time where you make some performance from bonds is when the economy goes through a little bit of a dip. But otherwise, if the world is going to be more capital intensive, there's going to be more demand for money to spend. And if the demand for money goes up, then the cost of it also will rise. And that's kind of the one of the big changing dynamics. So we've talked about how many of the what they call the hyperscalers, the people that provide the data centers, the Googles, what have you, they used to be spending out of their own pockets. Now they're actually borrowing money, so they're competing for the capital, right? So they have to pay interest on that capital to keep the build out going, and that has created another discussion point in the market, which is it is economy wide, but it's also very company specific. And we've talked in the past about how you have these four drivers of how a stock moves. So you have the revenue, you have the margin, you have the valuation, and you have the capital that it puts to work, right? So if you own a bank stock, they have $1 of earnings, they give you half of it back in a dividend, right? So that capital comes back to me, and then I get to do with what I want. I can put it into more stock. I can go and spend it. I don't have to. Obviously I want the bank to put the half they're not giving me back to good use, right? Make new loans and drive new activity and make a return on that. But when the dividend payout is higher, you don't have quite the same concern with what the company's going to do with their capital. When they don't give any of it back to you, and they keep it all, and they invest it, it's very important what type of return do they get on that investment. And that is the discussion point that you hear repeatedly around artificial intelligence. So on the one hand, the demand is very high, and where all these use cases, and are they going to make companies money? So if I'm going to put an extra 25 billion into my capex, and I'm going to depreciate that capital over, say, 5 years. So I need to have at least 5 billion. It's going to cost me 5 billion a year in my income statement for the depreciation. If I want to make like a 30% margin, then I probably need like 10 billion of revenue to make 3 billion of operating margin on my capital investment. So like to get to the returns, this is what people are struggling with. And when companies have great runways of putting capital to work at high returns, then their valuations expand. When people have concerns over the returns they're going to earn on the capital they spend, the valuation often contracts until people get a better sightline, right? Because it's obviously it's absurd, but like if I owned a company and you said, what are you going to do with your excess cash flow? And I said, well, I'm going to light it on fire. right?
Yeah.
You'd say,
Yeah.
well, I can't give you any value if you light it on fire, right?
Yeah.
Now,
Yeah. Yeah.
and and that's like, it's absurd, but it just kind of proves the point, right? Like a dollar that stays in the hand of management, a company, shareholders are very beholden to the success that management has with putting it to work. So if they can turn excess dollars into $2, $3, that's great. If people question the returns they're going to get, they factor that questioning in by suppressing the share price for a period of time until they see evidence that it's going to work. And that's what we're kind of going through right now. And then you see capital expenditure go up, so people say, well, that's good for the stuff they're going to buy. But then there's another camp that says, well, they can't keep buying it if they don't get a return, right? Like,
Yes.
because at the end of the day, everyone eventually will be logical. So there's just a lot of dynamics going on, on this discussion, and people are looking for clarity for how that will emerge. And that was probably the last thing that took place this week.
Yeah. If I keep if I take $20 from my wife to go and buy a bag of milk and some other groceries, and I keep showing up time after time after time with just a bag of milk and nothing else. At some point, she's going to ask me what I have to show for it. The bag of milk's $7, and there's another 13 that I should be spending wisely, but clearly I'm not. I'm doing something else with it, and she and I'm not giving it back to her like a dividend. So she's not she's going to start to doubt and going to start to put a tighter leash on me, and that's kind of what you're seeing with some of these companies, which is, I mean, just amazing. As you look through some of these reports that come out, like, I mean, Google reported this week, as you say, and increased their capex. The fact that these companies just used to be cash cows, they just used to spit off cash, and now they're actually cash flow negative, and often in many cases.
Yeah, now, and we have to be. This is another, I think, a really important point of the argument as well, is when a company has a dollar of cash flow, a portion has to go into reinvesting what they call maintenance capital. That's just to
Yeah.
maintain the current business. To be clear, Google is taking their cash flow to invest for the future. Like, the capital is hoped to have a return, and it will have a return of some degree. It's just people are debating how high will that return be relative to their expectations. So, like, if we take a totally different business, but like a pipeline company might have whatever, they have $1 billion of free cash flow after the dividend. They will take that $1 billion, they will go and borrow maybe another $1.5 billion, and they will put $2.5 billion into new capital investment to keep driving the growth. So, they too have negative free cash flow, but it's that portion that's going from investment. Now, the difference there is, on some of these old stable businesses, we have a greater degree of confidence on the capital that will, it may not be a booming return, but we have, like, the return is within the goalpost, so we can really think through quite clearly, how that's going to work. Like, if you took a utility, for example, where they're allowed a regulated return on equity, so if they put a dollar to work, we know they're getting that return, right?
Yes. Yeah.
That's at one end of the spectrum, versus another end of the spectrum is like, I'm putting it into a growth company, and I really have no idea what my returns might be, right? And so this data center sits in the middle of that fairway. They are going to earn a return, but the question is, how big will the return be, and how sustainable will the return be? And that is especially after strong runs, that's where the discussion starts to flare, right? And that's kind of the point we're at right now.
I sometimes, or quite often, like the dumb positioning of my question, showing my limited knowledge relative to you, and that's why you're here. But I think it helps everyone understand, because I always hear analysts talking about free cash flow, positive free cash flow, that's good, and negative free cash flow, bad. But there's nuance to it, just like everything with investing, which is why we have Tuesdays.
That's right. Well, it's great to talk. Oh,
Yeah, so Stu, yeah, actually, you know what? I think we're at a good time right now, and we've been running a little bit long with some of these, and I think you covered off a lot of sort of what's been going on, why there's why we're sitting in an unusual point, and then some of the stuff around capital spending and sort of what's driving the moves in some of these stock prices. I guess the only other thing maybe just before we do wrap up is, so we can finish where we started with is, once again, like not everybody's finishing up that whole week working right into 5 o'clock on a Friday like we are,
Yeah.
and that is sometimes reflective of kind of the season. There's a seasonality to the stock market as well, and this is kind of a period that is the dog days of summer,
Yep.
so to speak, and that applies to the stock market as well.
Well, when you get like, yeah, you often, the fall can be a bit of a tougher time on the stock market. August, September,
Yeah,
October. If you look back seasonally, those are not, not the strongest months. And we've been very strong into them. And as I say, some of these discussions are starting to emerge. And some of these discussions, unfortunately, are not going to come to a conclusion immediately. Um,
yeah.
so that's one of the dynamics. We have the midterm elections, so we have some things that are a bit more, some maybe some intermediate term challenges as we kind of move through the back half of the year, particularly after a period of very strong performance. So yeah, we're always taking that into consideration as well.
And this is why I think we've actually gone a record 3 episodes without mentioning an idea that even if the market's kind of softening, but you're putting new money to work and you're a little bit worried, so you might not want to put all the money to work at one time, there could be a strategy that
Well, it's
might work.
just a dollar cost averaging, Dave. You
Oh, what are you talking
yeah.
about? No.
And you think through times, and obviously when markets are at highs, you say, well, I wish I'd accelerated it. But it's just a great way to marry a long-term financial plan with how do I put capital to work over a long period of time, and what I know will eventually be, there'll be some variation in the environment, and I'll end up with a good average cost relative to my longer term financial goals.
Yeah. And again, it's just been such a winning strategy. And I think the other one is, as we always talk about, is that diversification, because you've just kind of seen these sort of rolling bear markets through different sectors,
Yep.
and that's been, so diversification, regular investing, all the basic principles of investing that we talk about that just seems so boring when you hear this story about this stock doing this in a short period of time and this stock doing this in gold and crypto and all these other things that have popped up over the years. It seems dull, uninteresting, but building wealth successfully over the long term sounds really exciting. But you got to be patient and you use the principles and you generally win. And it's when you forget those principles that you usually get hurt. And these have been the kind of markets I think that really teach a lot of those lessons, and they're important to learn earlier rather than later.
You got it. And even just segmenting in your head, what capital might be used for different objectives, and setting off like a long-term investment that's going to deliver against needs that are a number of years down the road. You're what you're really trying to capture is earnings growth, and hopefully you can accelerate returns by having companies whose valuation improve a little bit during the period of time. And that's what you're always rotating the company or portfolio, like you say, diversification, like uh, everything we've talked about, the strength of the economy, all sorts of things. Like, who would have thought that healthcare would be having a reasonable move in the stock market as well? So there's always things to do. There's always capital to take from these things that maybe are reflecting too much optimism, and sprinkle it over here where there's additional returns. And that also is just part of the long term plan.
Excellent. Well, Stu, have a terrific weekend, and I think we're scheduled for late in the week again next week, so We'll catch up with you next week with another edition of Stu's Days.
Great.
Thanks again.
This podcast has been provided by RBC Global Asset Management, Inc., RBC GAM, and is for informational purposes as of the date noted only. It is not intended to provide legal, accounting, tax, investment, financial, or other advice, and such information should not be relied upon for providing such advice. RBC GAM takes reasonable steps to provide up-to-date, accurate, and reliable information, and believes the information to be so when provided. You should consult with your advisor before taking any action based upon the information contained in this material. All opinions constitute our judgment and are subject to change without notice. The information presented here is provided in good faith without legal responsibility. RBC GAM reserves the right at any time and without notice to change, amend, or cease publication of the information.